Think big, trade smart. This video is presented by Meitou Investing. Just over the past few weeks, the techs were moving like a roller coaster, while for the recovery stocks, especially for the banks that went up like crazy. So it may seem like the market has a strong faith in both the recovery stocks and the economic recovery. But what if I tell you that the recovery may not turn out as expected? In today's video, I will talk about the 3 reasons why both the economic recovery and the recovery stocks are at risk, and what should we do to avoid these risks while also making money. So please do stay until the end of the video so that you will not miss out any of the important information. So today's video is kinda on the opposite direction to the mainstream point of view of the markets. I don't wish to convince all of you, but I wish this video can provide you some insight and a different perspective. Having said that, what exactly is this mainstream point of view that I'm talking about? Well, what I'm referring to is the market's expectation of a fast recovery of the economy and the full resumption of labor activity. Over the past few weeks, the majority of the recovery stocks had a very strong growth. Many capitals were moving from the high growth stocks into the traditional cyclical stocks. And there's a term to describe this movement. It's called sector rotation. In the context of this sector rotation, I will go through the 3 major risks of the recovery as well as a solution in response to them. The first risk, will there really be a retaliatory consumption after the recovery? The belief of a retaliatory consumption is almost a consensus to the mainstream. Most people believe that the pandemic has reduced people's desire to spend, which the recovery will definitely experience a massive increase of consumption in the mainstream's belief. And because of this mass belief, stocks of the consumer discretionary sector became the leading stocks in terms of growth over the past weeks. And I had to admit that I had this same belief in the first place, and most of my investments were purchased based on this logic. But as more evidence were found, I started to question myself, will there really be a retaliatory consumption? The following graph shows the US's total retail sales over the past 5 years. This stats also included the everyday groceries and products that every normal person are buying each day. And as you can see, the total sales didn't go down as expected, which the expectation was that the pandemic would reduce people's desire to spend. However, the graph indicates that the overall sales was growing, and it was growing at an unexpected speed. So if you look from another perspective, we may not see this total sales to reach this far and this speed without the pandemic. In other words, not only did not the pandemic reduce people's desire to spend, instead, the pandemic actually facilitated spending. But hear me out, this stat is only up to this March, meaning that half of the American states haven't restored their normal level of economic activity yet. In other words, the opening of the economy didn't single-handedly cause this growth in sales. Some people have said that this unusual growth was because of the American government's unemployment benefits, but I disagree. The typical reason to boost sales is the increase of the national average income, but the unemployment benefits didn't just increase the average earning at all. I don't think this extra $1,400 is going to boost extra sales in an effective way. But even if this unusual growth was due to the unemployment benefits, but after the economy is fully restored, what does the money of the retaliatory consumption come from? Like, when the economy is fully open, the government wouldn't have the reason to continue this temporary benefits, and that the people's salary wouldn't increase after the recovery. So this increase in sales actually indicated that people didn't save their money during the pandemic, rather, they have overdrawn all their spending power. And based on this evidence, it means that there's a risk on the belief of a retaliatory consumption, and we could even see a drastic decline in the overall sales after the recovery. We're currently having a very unique recovery in history. Many of the traditional models and expectations in regards to a recovery has proven inapplicable for today's markets. However, investors are still like to adopt the traditional mindsets to lay out their investments. In the traditional view, consumer discretionary such as electronics, furniture, cars, and luxury goods are believed to be the most purchased products during the economic recovery. And the small cap stocks are also believed to be the most favored sector during the recovery. But if you look at the market right now, many of the industries and companies related to retaliatory consumptions are already priced in. But the problem is, if retaliatory consumption didn't come as expected, there would definitely be a huge influence on their stock prices. The above risks are related to the possible outcome that could happen on the demand side. Now, let's talk about on the second risk, which is on the supply side. For this, we have to look at the employment rates. If you watch the news frequently, you're probably getting used to see all these fantastic employment rates over the past few weeks. Indeed, the employment rate is actually a very important indicator during the economic recovery, and is probably the most important one. The fast speed growth of employment rates may seem like a good thing right now, but if you're someone really familiar with the macroeconomics, you probably already noticed that there's a huge problem coming up, which is the labor shortage. The non-farm unemployment rates in America right now is currently at 6%, which is a standard level in any normal situation. This means that most of the workers who are capable to work have found their jobs. But here's the thing, half of the American states haven't restored their normal level of economic activity yet. It means that many of the businesses are still closed, while the unemployment rate has already closed to a normal level. And here's the question. When these companies, especially small companies, have resumed work, where do they go to recruit their employees? Nobody should take this decline of the unemployment rate as a good thing right now, because the labor shortage as a result of it could bring a huge impact to America's economy. Let's use the food industry as an example. Because of labor shortage, many restaurants will be forced to shorten their opening hours. And those restaurants that could have opened for 24 hours, thus would reduce their hours of operation. Or they may even have to shut down the store. And this would definitely affect their revenue. So, how do businesses solve the problem of labor shortage? The answer is raise salary. So for example, Amazon has just announced to raise the salary for its 500,000 workers. And Costco, just last month, has announced that it will raise its minimum wage to $16 per hour. This means that the company's overall cost has increased. This increase of cost by raising salary is only a small rate for big companies because they can fill the increased amounts by charging more on their products to their customers. But for the small companies, it could be a nightmare. They either couldn't pay the higher salaries, or even if they could, the companies may not be able to raise their product prices because consumers are very sensitive to prices. Thus, it will reduce their revenue. According to a stat, currently there are 42% of small businesses have labor shortage, and this stat is at a historical high, meaning that the labor shortage is starting to affect the economy. I have discussed in a previous video that the small cap stocks are traditionally the most benefited from the economic recovery because they are the most sensitive to the economy. But because of their sensitivity, the labor shortage in this unique recovery may result small cap stocks experiencing a completely different recovery process. The following screenshot shows that the small cap stock ETF IWM had a very outstanding performance over the past year, meaning that the market has already priced in the small cap stocks. I have been buying small cap stocks since last October, but recently I have slowly reduced my holdings on them. It's not because that I don't believe that small cap stocks will no longer get the benefits from the recovery, but my reasons to sell them is because the risk is increasing, which the return to risk ratio of the small cap stocks is becoming worse. Lastly, let's talk about the third risk, which is inflation. Whether you agree or not, the person having the biggest say on inflation right now is probably Jerome Powell. Powell has been trying to avoid direct conversation on inflation. Even when he did decide to talk about it, he always says things that both interest and inflation are not gonna go up. But really? I doubt it. Because of the many signals and evidence found, I'm not very convinced that we should not care about inflation, because these signals are so obvious. Let's talk about the demand side we just went through. America's total sales are increasing at a historical high speed, and this is a classic signal of inflation. At the same time, unemployment rate is also making people worry. In terms of the macroeconomics, it doesn't always mean that the lower of the employment rate is, the better the economy. Every economy has its own natural unemployment rate. If unemployment rate is lower than this natural rate, it means it would trigger massive inflation. In the US, the natural unemployment rate is widely believed to be between 4 to 5%. and the unemployment rate is currently at 6%, meaning that we're not far away from the red line. And as more states restore their economy, the unemployment rate gets lower, the market may turn from the happiness to sadness. And on the other side, the signals from the supply side we just went through are also critical. As we have talked about that the labor shortage is making companies raising their recruitment cost. And this part of the cost will eventually pass on to consumers, which is on the product price. The stats from the US Department of Labor shows that the food industry, which is the most sensitive to the recruitment cost, has raised their prices for 6.5% in this March compared to last March, which is also the biggest increase since 1998. This means that the massive inflation has already started to take place in America. Also, we shouldn't ignore the commodity prices that just went up recently. The Bloomberg Commodity Spot Index has just reached to its 10-year high. Copper prices has also came to its all-time high. Crude oil too also went from last year's negative price to a recently $65 per barrel. Timber and agricultural goods has also reached their 10-year high. So the problem is that whether the increase of these commodity prices is temporary, or is it because of the heated economy? If it's because of the heated economy, then it will result in an extreme inflation pressure. Even though the inflation is actually a very common phenomenon during the economic recovery. However, the problem is that almost all the macroeconomic factors are pushing inflation pressure, and there's no sign that this trend will slow down. So here I have another stat to prove it. The CPI of this March increased by 2.6%, which is a 30-month high. And April's CPI also increased by 3.6%, which is also a 10-year high. So if inflation did come, what effects will it bring to the stock markets? Well, in the short term, an increase in the long-term interest rate is the most possible outcome, which would result in a systematic decline to the stock markets. And in the worst case scenario, if the Fed decided to push to raise interest ahead of time, then this may cause a violent market turbulence. So we may see another crisis back in 2008 that Nasdaq was down by 20% because the Fed decided to raise the benchmark interest rate. If the same thing happens again during this special recovery, the crisis may be even worse. However, even if the market is pressured by worries about inflation, it doesn't mean that we have to give up investment. The recent sector rotation suggests a solution for us. So instead of investing on the high-growth technology companies, traditional value stocks with stable cash flows are more resistant to inflation because they can just raise their prices. I also made a previous video about the value stocks and the sector rotation. You can check it out in the link below in the description. But generally, I believe the sector rotation will last more than just a year. So let's go over the 3 risks. Firstly, the retaliatory consumption may not come as expected, and there are still some major risks during the recovery, meaning that these cyclical stocks that are doing well recently also has some risks. And secondly, as unemployment rates keeps going down, there are still risks on the small cap stocks. And last but not the least, the worries on inflation suggest that the trend of sector rotation is highly possible to continue. And investing in the blue chip stocks and the low risk ETF are the most safest choice. All you have to do is just wait for the next opportunity. Those making money in the stock markets are always those who are the most patient. If you like my videos, please click the subscribe button. Your supports are much appreciated.